Hey everyone, today on the final bar, back after a long weekend here on Tuesday. The question going into the weekend after Thursday and Friday's sell-off, does the sell-off have staying power? We're going to dip a little further down this week and get the follow-through. If today was the answer was further downside. We talked on Friday about all the different components, how to think about potential downside risk. On Monday and now on a Tuesday, our normal routine is to hit the market from a top down, from sectors, from bottom up. We'll approach all three, see what answers we can come up with. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com here in Redmond, Washington. Thanks for joining us every weekday after the close to try and make sense of these markets. And if it feels like it's tough to get a read on things, you're in good company, because I think a lot are struggling now, given the last three trading sessions with plenty of distribution. Is this the signal that we all are going to look back and wish we paid better attention to, projecting or increasing the potential for further downside? Or is this the most viable dip ever, with a lot of individual names sort of pulling back to their 50-day moving averages? We're going to try to go through some of those different themes and see how we can answer those questions. And to be honest with you, I'll tell you what, hopefully I've mentioned a number of times before, on a big sell-off day, on a big distribution day or days, that is not the time to start developing your exit strategy. A week ago, when the S&P is making new highs, when it feels like a downside is a remote possibility, that's the time to be thinking about potential downside. Having said that, it's not too late if you're still trying to make sense of things, and hopefully we can help you as much as possible. We have some wonderful guests on StockCharts TV, and particularly on the Final Bar. This week, a little shorter week because of some scheduling challenges. So we're going to have Fred Meisner joining us from Atlanta tomorrow. I've known Fred for a number of years. He writes the Fred Report and does a lot of great work with financial advisors. So I'll have him joining the show tomorrow. Next week, on the 15th, we have David Settle from Market Scholars. And on Wednesday, the 16th, Pat Ceresna from the Market Huddle podcast and Big Picture Trading. Should be a really cool discussion there. Also, in a couple of weeks, coming up on September 22nd, is our event called Introducing StockCharts ACP. We've been capturing some fantastic conversations with people like John Murphy, Martin Pring, Ralph Acampora, Larry Williams, Mish Schneider, Arthur Hill, many, many more, sharing how they're contributing to the ACP, the Advanced Charting Platform, and also Chip Grayson and I from the StockCharts management team sort of unveiling some of the key features of this new part of the StockCharts product. So join us on September 22nd as we share all the latest news there. As we get to our market recap here, I did want to start with a poll. It's a very timely poll. We asked about stop loss levels. We actually slated this to run, going into the weekend before all of this happened. So maybe it would have been good to run it a week earlier. But the question was, when you're setting a stop loss level, which technique do you use the most? We gave you a couple choices: support and resistance levels, percent stops, or average true range, or other. Over half of you, 54%, said support and resistance levels. After that, percent stops, average true range, and then other. And I'm not surprised. It's actually what my experience has been as well. And what I mean by that is, when the market starts to turn, or when a position starts to turn, what do you use to manage the potential downside risk? Support and resistance strategy is look to the left and identify key pullback levels. And if we hold the recent levels, that's you remain bullishly positioned or expect a further upside. If we break them, you get out. A percent stop would be we break a 3% off of the high, or 8% off of the high, or something like that. An average to range would be, here's the range that the stock normally trades if we break 3 times the ATR or something like that. You do, and that's more of a volatility adjusted stop. And other could be obviously anything. Support resistance is actually a timely poll question for right now. We're going to start here with the chart of the S&P 500. The S&P down almost 3% today, closed around 2 and 2.8% lower. And what's interesting is the close pushed us just below 3350. What we talked about going into last week, and to refresh, this purple shaded area is that first sort of line in the sand, and it comes from Dow theory, right? From Charles Dow's theories over 100 years ago, which was an uptrend is a pattern of higher highs and higher lows. A downtrend is a pattern of lower lows and lower highs. And as long as the highs keep getting higher and the lows keep getting higher, the trend is positive no matter what you think should happen or whatever. Now, we made a higher high last week, a new 52-week high, again, after a series of all-time highs on the S&P. But now we've made a new swing low. We've closed below that low from mid-August, which I would identify as the most recent sort of tactical low. So if and when we rally a lower high or a higher high confirmed by weaker momentum, a bearish divergence, we're sort of, we've talked about being in the beginning of a topping pattern. I think the last couple of days is sort of validating that thesis pretty well. So again, we broke below the swing low. That's step one. You now want to look for some sort of lower high, and that would confirm it. But at this point, you're really looking for some follow through. The 50-day moving average is increasing. It's around 33.05. That would be that next key level, which again, if we sell off again tomorrow, that certainly could be in play. The real line in the sand from my perspective, though, is 3,200. That's the low from July. That's after we broke above the June highs finally and then sort of pulled back. We spent a lot of time in that range, spent about 2 to 3 weeks in that 3,200 to 3,250 range. That's the blue shaded area here. And if and when we break this, which we arguably have done today, assuming we get some follow through tomorrow, that's where I would be identifying. I think when we do reach that point, that's when you have to decide whether or not you're positioning for much further potential losses, or whether you think this is the ultimate buying opportunity before we rebound a little further. But based on what I've seen from the charts, I don't see a lot of downside capitulation just yet. I see things rolling over with certainly the potential for further downside. So I think as a trend follower, you're looking for key levels to be broken, whether or not they hold. Let's get back to the dashboard. We'll keep it at a macro level just for this, because we're going to talk a little bit more about sectors and a little bit more about individual stocks, but just some key themes that come off. Mid caps and small caps all down, and the S&P was down 2.8%, mid caps 2.3, small caps 2.4. So everything was down in pretty similar fashion, all down in that range. What was down a lot more was the NASDAQ 100, and you can see that technology as a sector was down 4.5%. The XLK was the worst of the 11 S&P sectors, and the NASDAQ 100 down 4.8%. The VIX a little higher today, almost up to 32. Where there was some strength was in the bond markets. They actually rallied pretty good out of the open, and then sort of slowly gave back some of those gains during the day, but still finished up 0.6% on the TLT. The dollar also finishing stronger, more toward the highs of the days, with the UUP up 0.5%, 10-year yields down below 70 basis points. On the commodity side, gold essentially finished flat, sort of opened lower, but recovered much of that. Silver down 1.2%. So commodities as a whole, pretty much lower, and that was energy with the USO, natural gas, all down over 6%. So essentially, this was a risk-off day for the most part, with the only upswings from the dollar and from bonds. Everything else pretty much flat to down heavily. We talked about a daily chart of the S&P. I just wanted to hit very quickly on some breadth reads. This was one of our 3 and 3 on Friday, which is looking at the cumulative advanced decline lines for each of these measures. This is not quite updated for today's close just yet. When it does, I think what we might find is that the small cap breadth has broken below that August swing low. That's sort of the level that I would be looking for on any of these. That would convince me to change it from a beautiful amber to a beautiful red color, confirming a downtrend. And I think with all of these, depending on how steep of the pullback it was in the advancers decliners, based on what I saw during the day, I think it's pretty safe that at least a couple of these are going to turn lower. And I think that is a follow through to the weakening breadth pattern that we've seen over time. As a reminder, the S&P is the only advanced decline line that has made a higher high through the beginning of September. All the rest of these have now made a lower high, and I think that lower high is going to be more obvious after we get the closing details for all the stocks today. So overall, breadth has been more cautionary. I think it's going to start to turn a little more negative based on what we saw today. And again, the question now is, with any stock, with any position you're looking at, look at the current bar, the final bar, look to the left, see where we're at relative to some of those key levels. Our next segment is called Sector Setup. So we've now talked about the top-down macro, identifying this rotation lower and the follow-through today. Let's look at the sectors. The 11 S&P sectors start to make sense of some of the patterns we saw there. So we're going to look at the RRG graph. This is Julius de Kempener's creation, visualizing the 11 S&P sectors and how they rotate around the S&P in the middle. So just to hit on, we've hit on this every week. So if you missed this, go back to our Monday shows. We usually go through this visualization and talk through it. But some key changes since the last time we've reviewed this. Number one, technology has made another 180 and is now heading in the direction of deterioration southwest. So it had been sort of making circles around in the weakening quadrant, but trying to rotate back in the leading quadrant. And because it's furthest to the right, that means it's the strongest relative performer over this long-term time frame. But over the last couple of weeks now, you can see that the XOK has rotated southwest. And that means it's starting to, the outperformance is becoming less strong. The relative strength is starting to turn lower, which you see that on a chart of the XLK. You can see it's rotating lower. And then, now overall, it's starting to increase further to the left, and further on the y-axis, further down, which means the momentum is actually shifting as well, getting more negative or less positive. So technology and the deterioration of technology is key, especially because this is a cap-weighted measure looking at the XOK. Let's look really quickly at a chart of the XOK to stick on that theme. I had published something like this on Twitter this morning. A couple things happened. Number one, my point on this was technology has been a relative outperformer since the market low in 2018. So even with the pullback we saw last week, it's still holding above trendline support. If you look at the XLK on a relative basis here at the bottom, this is the XLK relative to the spiders, the SPY. Until that breaks, you have to assume that the outperformance is going to continue. Two things have happened since then. Number one, my friend Mark Newton from Newton Advisors wrote and made a very valid point, which is if you look at the equal weighted XOK, it's actually the performance is a lot less attractive. The cap weighted XOK are the big mega cap names. And I don't disagree with that. I think Mark makes a really good point there. My point, though, is if you're allocating to technology, you're most likely allocating to a sector fund, something like the XOK, which means you're making a bet on the cap-weighted performance of the XOK. So that's why I think it's valid to point that out. But as a stock picker, his point is fine, which is you're absolutely right. There's been plenty of deterioration. We're going to talk about semiconductors a little later in the show. The second thing that happened is by the close today, the XOK has actually broken down through trendline support for the first time here since the 2018 low that I've been tracking. So what's concerning is this is the beginning of a period of underperformance for the for technology. And again, it's still early on. The XOK hasn't broken key support. It's still above its 50-day moving average. So I'm not saying that's the end, but it's interesting to note that the impenetrable armor of the outperformance of the XOK potentially showing some weakness there. Other things to point out, consumer staples are going just due north, which basically means still on the relative side, still underperforming, but the momentum is going positive, which means it's starting to look a little more attractive. If this rotates more to a northeasterly direction, that means the momentum is improving and the relative strength is improving as well. Others that are starting to look better, financials, which have actually rotated back from going southwest to now northeast. And if you look at some of the charts, like Capital One, we talked about on Friday. Others, we're starting to see some potential improvement. I think there could be opportunities in there. The challenge today is a lot of them got beaten up. Things like T-Row, Fifth Third, we're going to talk about in a little bit. These are charts that are really testing a 200-day and failing, things like that. So overall, on a relative basis, starting to do a little bit better on a price basis, I think is what's still concerning there. Finally, I just point out utilities starting to rotate a little more positive. It's diverging from real estate, energy, healthcare, which are all sort of firmly heading in a weaker direction. Utilities potentially starting to improve, and that's one relative strength line I would certainly be looking at. Looking at the 11 sectors, let's go back to the candle glance view. And what I would point out is just, again, my first step on this, after we look at the relative rotation graph, is see where each of these are at within their longer term trends. And I think what has changed is the XLV healthcare has now broken down through its 50-day moving average. Staples are remaining above consumer discretionary, communication services, industrials, materials, all remaining above ascending moving averages. That's all good. Technology testing its ascending 50-day right now, right? Very, very close to it. And I think if, being able to hold that 50-day moving average is going to be a really important test for technology. Also because I think this has been a safe haven of sorts where a lot of people have been rotating, trying to ride some of this this uncertainty out. And if those big tech names are starting to roll over and that starts to be a weight on people's performance, we're going to rotate then. I think that's where a secondary rotation into things like utilities would be a really interesting signal to be looking for. In terms of other key patterns, the XLF financials, we've talked about this, and again, I'm always a little bit skeptical when I see charts break above their downward sloping 200-day moving average and be unable to hold it. And that's kind of what happened going into Thursday and Friday. Thursday was actually starting to trade above its 200-day, closed back below it again on Friday, and now following through to the downside. And as we'll talk when we get to shifting stocks, there are some individual names in there that I think are concerning as well. We've talked about energy, and again, I've cautioned as much as I can, things going down with struggling relative performance is not an area I enjoy fishing in. And I think what we see today is the follow through. A lot of members of the XLE and also down in the cap tiers and the mid caps and small cap space and energy breaking down through key support levels. And again, I think in general, as a trend follower, it's hard for me to get excited about charts where they're underperforming consistently. And that's what I'm seeing from the energy space. Finally, I mentioned utilities, and I think it's just worth noting, even though the price is holding up, it's not great. I think one of the key signals we may be seeing right now, as technology is breaking down on a relative basis, utilities potentially breaking out on a relative basis. Looking at the last 4 or 5 months, you can see the high from April, the high from July, and now we're just starting to rotate higher. So while the price itself does not get me very excited, you want to see it, be able to reclaim its 200-day and hold that. The fact that the relative strength is turning up tells you that people are rotating. If you're allocating within equities, there's an opportunity there to potentially ride downside out in a more of an income generating sector like the XLU. We need to take a quick commercial break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Appreciate you joining us every weekday for our show. Get your questions to us. We'll do some mailbag segments during the course of this week. We'd love to answer one of your questions on the air. 2 ways to get a question to us. Number one, via email, thefinalbar@stockcharts.com, or on Twitter, just tag us in a comment at FinalBarSCTV. On our YouTube channel, put a comment below the video. We can get in there as well. And at the end, we'll bring all of those together, answer as much as we can. Just noticing, by the way, as I'm looking at the camera shot, which you might have gotten in the open, I think my t-shirt or my dress shirt is labeled an which if you know French means I have myself labeled as a man because my daughter's learning French. And so my wife actually put labels on all of our clothes to reinforce who was. So sorry for that. Having said that, let's get to our final segment, Shifting Stocks. Here what we do, as I mentioned, over the weekend, I like to look at the S&P 500 chart by chart and look at some of the patterns. And I've often found over my career that patterns, signals, reversals will often reflect themselves on the individual charts. You'll see groups and themes and stocks turning before the broader indexes were reflected, because that's where a lot of institutions are making bets, and that's where they're seeing opportunities. And so what we like to do on our beginning of the week is review as many of these as we can. We're going to get through as many tickers as I can here. Starting with communication services, we're starting with the chart of Disney. And I think it's worth noting that even on a day when a lot of stocks are down, a lot of stocks are struggling, it is not the end of the world for stock picking, because here's Disney, which is up 1 2/3%, just hitting 134, threatening to make a new swing high for the last 6 months. If you look back since the March market low, Disney's been in a pretty consistent, for the most part, pattern of higher highs and higher lows. Relative strength had been sort of stagnant for the last couple months, but look at how it's just starting to make some new relative highs, swing above the August peak, make a higher low on a relative basis. It's starting to look a little more constructive. There are a number of charts that look kind of similar. See if you can find some of as we go through some of the other the other stocks around here. Within communication services, the others that I would point out, just a point out on Activision and Electronic Arts. Many stocks are down, so I don't mean to single these out, but these are some of the names that had been very constructive, made a new high in beginning of August. Now all of a sudden making a new lower high. And what concerns me is a lower high and now a lower low is by definition starting to be a downtrend. So the more stocks that do this, make a lower low and a lower high and break below their 50-day moving average, that would cause me to feel a lot more skeptical about the overall health of the market. EA even worse, down 4.5% today. But what concerns me more than that is, again, the lower high, the lower low, the breakdown below the 50-day moving average. EA is actually oversold. A number of stocks have already gotten down to that oversold region pretty quickly. It's not too long ago. The stock's making new highs 3 or 4 weeks ago. So again, that is a pattern I'm not seeing across every stock, across every sector, but it's something that certainly concerns me. When I'm looking at the FANG names, you feel probably less negative about the overall market condition if you look at something like Netflix, because Netflix, Amazon, home builders, things like DHI and LEN, Lennar Homes, are all sort of looking like this. They're sort of pulling back to an ascending 50-day moving average. That's why it's a really crucial point here. After last week's pullback, Netflix was still down, but closed above the open, which is potentially newsworthy because it traded below the 50-day but didn't close below it. If stocks like this are able to hold the 50-day, I think you could assume that overall market downside might be a little more limited. Amazon sort of closed right at its 50-day. If through the course of this week we see those levels breaking, if the RSI gets below 40 on a lot of these, I think things could look a lot more negative a lot more quickly. So that's what I'd be looking for. And again, with the home builders are sort of in a similar configuration. Going back to the things are not horrible theme as we go into consumer discretionary, I would point out something like Gap, certainly testing all-time highs, testing previous highs, which is pretty significant, has not broken through it. But overall, look at just that consistent uptrend coming out of an overbought region, totally granted, but overall not breaking down in any horrible way just yet. So I think it's worth paying attention to. What concerns me about some of these stocks, and maybe GPC is a good example, one of the auto parts names, you get a lot of bearish divergences right now on some of these. So GPC actually finished the day flat from Friday's close. You can see the higher highs in price, though, and the lower peaks in RSI. So the bearish divergence is what concerns me on some of those. Tesla has gotten absolutely clobbered, as you probably know, because everyone wants to talk about it, and I totally get it. It's been certainly a high-flying name that's come down to earth very, very quickly. It's worth noting that GM and Ford are actually appreciating pretty well. GM actually today rotated back above its June high. This is after breaking above its 200-day moving average a couple weeks ago, and so it's actually rotating in a position of strength. Tesla down 20%. I know the percent swings are huge here. It's right at its 50-day moving average, and that's what I would look to see if it's able to hold. Charts like Nike are what make me, not horribly negative yet. Nike's obviously made a new 12-month relative high today. It's holding up, and again, it's not, it's actually in this nice consistent uptrend, higher highs, and even though it's pulled back in the last couple of days, still holding up. So parking in names like this as things sort of potentially, evolve and we look for potential breakdowns, I don't think that's a bad idea. Within consumer staples, things got pretty ugly pretty quickly, and CPB is one chart I'll show you, but you could also look at General Mills, Kellogg, Kraft Heinz, Clorox. These are all stocks that have broken down through key support very quickly, and that basket of names has gone from looking really solid to really painful very, very quickly. In a downturn, you'd expect names like that to hold up okay, but we're not seeing it right now. Costco, not CPST, forgive me, COST. Another one, this is a huge bearish divergence going into Thursday's close, right? Where you have the big up day followed by the big down day. That's why we pay attention to those patterns. Apple had a big one as well. And you can see now it's, pulling back again. It's still above its 50-day. It's still holding. It hasn't broken down through a key support level from recent. So I think that's a name to certainly be looking for. Energy looks pretty bad. And I'll just show you one stock just to confirm that I'm not making that up. We'll look at ConocoPhillips COP. Essentially most of energy looks like this: lower highs, lower lows, rolling over. It's oversold, and that's great. But I would want to see a name like this actually demonstrate its ability to find support before I would get excited about it. Looking at financials, we're going to look at financials and tech really quickly here before we finish off. Sorry. I'm typing with just my right hand. It's creating some problems. T. Rowe and some of the other financials, what is a bit of a concern here, right? So T. Rowe and some of the other financial stocks looked really good, especially relative to the rest of financials. But you can see the relative strength has been pretty negative. Relative to financials, probably not as bad, but relative to the overall market, pretty bad. This again has broken down through support, lower high, now breaking down through its 50-day moving average. And so I think it's starting to show more signs of distribution. Fifth Third, FITB, is another one to pay attention to. This is actually potentially looking to break out, and it has not done it yet. We talked about that last week with some of these financial names that had looked pretty good, and I think you'd want to see it able to eclipse its 200-day before I feel really good about looking at a name like that. To wrap up in technology, again, Apple with the bearish divergence pattern here that we saw last week has followed through to the downside. The ascending 50-day moving average is what I would certainly be looking for. The other thing to pay attention to within technology is semiconductors. The SMH is a group we look at a lot for relative strength. And again, when semiconductors are outperforming, when they're holding up well, that tends to be a good thing for the overall market. It tends to be the market conditions are overall pretty positive. Now we're seeing a group that's now broken down through its most recent swing high, broken down through the 50-day moving average. And if you look at individual names, things like Applied Materials, things like KLAC, LRCX, they all don't look that bad, but those are all pretty large cap names within the space that have all broken down through key support levels. This is Applied Material breaking down through its 200-day moving average here for the first time since May. So overall, the takeaway I would have from individual stocks, number one, the good news is there are names like Disney and like Gap and Nike and others that are holding up just fine. So I think if you're in equities, there are places you can be. Observation number two is a lot of stocks are pulling back to key support levels, especially with things like Netflix and Amazon home builders. I'd be looking at the 50-day moving average, see if it's able to hold it or not. Finally, there are a lot of names that are breaking down in a pretty big way. And when we look at the breadth measures rolling over, that's what's causing it. It's all those names that are really starting to show some internal weakness that's, again, not necessarily reflecting itself yet in the broader S&P, but it certainly will feel the pain relatively soon. That's shifting stocks. We need to wrap the show and go to the 3 and 3 charts in 3 minutes. Here we go. Chart number one, we didn't get to this in the macro segment, but I did want to put it on. This is the S&P 500 bullish percent. At some point, we'll probably spend some more time going through this. And if you don't know this concept, look for the Chart School article on our website about the bullish percent indexes, because it does a pretty good job of explaining the methodology. But basically, it's a bear alert pattern, which is when over 70% of the S&P is in a bull market phase, meaning its most recent signal is a buy signal, and now it's rotated back below 70%. This happened in June most recently. This was after that June peak when things started to get a little more choppy, the last sort of corrective pattern that we've seen. And so we're showing a similar pattern to this June pullback, which at the time felt like that could be the beginning of something much deeper. What happened here is we established a swing low and then didn't get below it. Right now, we're still trying to establish that first swing low, but the bullish percent line going back below 70 is the first signal of internal weakness there. Chart number two is utilities. As we pointed out, we have the relative strength of technology rolling over. We have the relative strength of utilities rolling up. When I look at the bull market top checklist, which I wrote an article about a couple weeks ago on my blog, The Mindful Investor, we talked about a rotation away from offense into defense. This is one of those patterns I would be looking for, and we're potentially starting to see the beginning of that rotation today. Finally, when we looked at shifting stocks, we thought about the rotation. I think the relative strength of semiconductors is an important thing to look at. Today, we actually broke to a new swing low on that relative strength, and the relative strength of the SMH starting to roll over. If you look at this relative strength, I would not tell you that head and shoulder patterns on relative strength is a great trading system, but I will tell you it speaks to the weakness and the rotation from an uptrend to a downtrend. We now have lower highs and lower lows, and that ratio showing the weakness in semiconductors. If that continues, I think it'll be hard for the market to appreciate meaningfully in any way from where we're at right about now. Folks, that's our show for today. I want to appreciate you coming on this journey with us, looking at the macro picture, the sector rotation, the bottom-up stock picking. Get your questions into us via email, thefinalbar@stockcharts.com. We'd love to answer one of your questions later this week. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.